Also,
Yeah, hi, thank you. So, welcome everyone for today's CPE session. So, thank you for the brief introduction from DJF. I know I think it's IPL night tonight. Everyone is eagerly waiting to go back and at least watch the glimpses of the match. So, as much as possible, I'll try to keep the conversation as crisp as possible. As much as possible, let me try to engage you. One request from me would be to keep your microphones on mute as much as possible. When there is a question, you can stop me in between. But otherwise, when you have other conversations in between others, please keep your mic on mute. So that would be my number one request. Because when I saw the conversation, when Kajal was introducing and when the executive was also talking, there were some disturbances. So that is number one. Number two, I'm going to set the agenda for the day. It's 6:02 now. We will sharply close somewhere around 7:50, 7:55. I'll leave you a little early. I understand it's a long day. I'll try to leave you a little early. So the last 20, 25 minutes after somewhere around 7:30-ish onwards, it will be more of an interactive session. My microphone, am I audible? One second. Let me try to, there is some, okay. Now am I audible? Beautiful, right? So there needs to be some adjustments in the mic that I have to do. Okay. So, so 6:03 to 7:30, we'll be having discussion. Predominantly, I'll be talking. Wherever you have a doubt, you can stop me. That's okay. But try to park it as much as possible for the session between 7:30 to 7:55. That 25 minutes, park your questions as much as possible. But if you think it's very important, please go ahead and stop me in between. So that's with that, we will start the session for the day. I'm going to share my screen here now. I'll have to put my mobile on mute. Okay, so right, pretty much as you might all have guessed, this session would have parts of my previous session also inbuilt in it, in case if for lack of clarity, anything that is left out, if you have any doubts, you can get it clarified here. But otherwise, it will be more of a practical session where we will try to understand what and how are we going to select our inputs with regard to valuation. Theory would be there, and there will be, wherever possible, we will try to bring in our practical concepts also. So this is number one. I put my mobile on mute now. Beautiful. Now, moving forward. So input selection and valuation, international valuation standards is these valuation standards that predominantly everyone in India is using, except for ICAI, which is using its own ICAI RVO's valuation, ICAI's valuation standards. Apart from that, everyone else is using the international valuation standards. So let's start from the international valuation standards. 105. What does it say about valuation inputs? Valuers should maximize the use of two important words are being used here: relevant and observable market information. Market information used to be the focus in most of our conversations previously, but now, because we have made sure that market information does not only related to the market method, it also relates to our cost approach, it also relates to our income approach. I'm going to diverge a little bit and concentrate more on the two words that are used: relevant and observable. So market information can be observable, not observable also. If you are well versed with IFRS, you would have all known about the level 1, level 2, level 3 kind of inputs that are available for fair value determination. So observable market information takes the top priority. It is applicable for all three approaches of valuation. I hope you understand the difference between approach and a methodology. Under an approach is like the direction, methodology is like the exact route that you'll have to take. From say Bangalore, I might have to, if I'm reaching Delhi, I'll have to go north, but the exact route would be the methodology. Now, I am going to put in more emphasis on the other word that is being used, which is relevant observable market information. Irrespective of where you are picking up this information from, can be observable market information, but you should pick the relevant observable market information from the market, because lot of information is available now that it has become an information world. Lot of information is available. You'll have to look for, you should know what you're looking for. Otherwise you will be lost in the sea of information and you will be picking up wrong information. So relevant information is the key phrase here. As we move by what is relevant, how do you get relevant information is something that we'll have special focus on throughout this session. Regardless of the source of inputs and the assumptions used in evaluation, evaluator must perform appropriate analysis to evaluate those inputs and assumptions and appropriateness for the valuation purpose. Now, a simple example that I can tell you is, which is going to also come in the very next slide, is going to be risk-free rate. When we take risk-free rate, what is risk-free rate is something that we'll discuss. But when I'm saying risk-free rate is what instrument am I supposed to take? What is risk-free? For me, something is risk-free. For you, something is risk-free. In case if I'm taking risk-free, if I'm saying government bonds are risk-free, which government bond should I take? All these comes into play. So that needs to be kept in perspective with relation to the relevant observable market information. Now let's start with the simplest, easiest, and the most not noticed, if I may use the word not noticed kind of information that we pick up, which is the expected cash flow. Predominantly as valuers, we back our hands off and we go ahead and say that this information is not for us. This information is given by the management. I got it in the management representation letter. I'm happy that they have signed it off. I'm having appointment letter. I'm having engagement letter. MRL. In MRL, I have an annexure. In that annexure, they have signed and they have said they can buy the moon and the sun, probably if not the 9 other planets. So that information can I directly incorporate in my valuation model? The important point that we might have to take into consideration is you should always carry a lens. Any information that is given by the company or the management needs to go through into the valuation report after it goes through the eyes and the lens of the valuer. Look at what is the cash flow that they have given. Look at two things. One, look at their past performance. When an futuristic cash flow or future projections are given by the management, also get the past 3 years, 5 years performance of the company. If it is a startup, it's fine, but then it should work like a startup. It should not be, there should not be any it cannot jump year on year, which they think would work, but sometimes it makes all the more sense for you to look at the background and then take a call on it. The growth that is being shown in the revenues as well as the profit, look at it from the point of view of what is the market size first. If there are going to be 100 students who are studying in a city, who are students in a city, I'm just taking examples here, 100 students who are there in a particular area, and the new teacher comes and she starts a tuition center, and you go on to say that first year I will be teaching 5 students, next year I'll be teaching 50 students, next year I'll be teaching 500 students. Doesn't make sense. There are 100 students this year, next year the market size is going to, from 100, it's going to become 110 or 120. So look at the market, whether the what the management is gauging, whether is it going to make sense in the future, considering the entire market size is one of the main factors that you'll have to see. That is number one, looking at the market. The second thing is the industry, not from the customer perspective, but the competitors. How many competitors are there? How tough? So all your Porter's 5 forces model, etc., would come into play here. This is where all that will come into play. Look at the competitor. How much share is he holding? How technically advanced is he in comparison to you? Or if you have an edge over him, how long can you capitalize on that edge? Early mover advantage, whether do you have it or not, or you are being sidelined. How is your customer? How is your supplier? All this information needs to be gathered. And then through that lens, you'll have to look at the expected cash. Whether I will be able to make that super profit or not should be viewed with that lens. After that, you'll also have to look at how the company is performing. Is there any problem? Look at the audit report. Is there any problem that is coming in the future? If you are valuing a typewriter company, the typewriter technology is gone, but people probably buy it for some fancy as a collection. They might buy a typewriter, but otherwise there is no actual need for a typewriter. There are institutions which use typewriters for helping people with the typing skills, but apart from that, nobody else is using a typewriter. So look at what this particular industry is looking for, and then based on that, your projection should be there. This is number one. So this is a broad outline that I'm giving. Next, you move on into the two kinds of cash flows that we have. When you are calculating the free cash flow, usually when you look at it from a broader perspective, what you can expect from a publicly traded company would be only the dividend. Your capital appreciation is not something that you're going to take home. It's only the dividend that you will be looking at. And if you use the dividend as the cash flow for you, then it's going to be the dividend discount model. Straightforward. That's where we started. In all our equity related classes, that's where we start. Dividend discount model would be the first discount model that we'll discuss about. Then we'll move on to equity discount model or earnings discount model, where not just dividend, but what is earned by the company would be taken into consideration. Then slowly we will move on into the cash flow, because what is earned is not directly going to be distributed. Some of it is going to be retained, some of it is going to be distributed as dividend, but what is earned as cash needs to be taken into consideration, because I might earn 100 crores this year, but as per the contract terms, if it is going to come after 5 years, it doesn't make sense to value it at 100 crores as on today, because it's going to come after 5 years. We'll have to discount it. So cash flow based discount models came into existence. Now, when cash flow based discount models came into existence, that's where we'll have to look at who are you. If you are going to take all the cash flows that are relevant to both the equity holders and the debt holders, you're going to be calculating on it. You're taking a different train, the free cash flow to the firm. And if you're taking only the cash flows that are relevant to the equity holders, so essentially all your profit after deducting any debt-related payments, principal payments, or debt-related interest payments, all this, if you have removed, it's your free cash flow to equity. Why is it relevant? Because this will affect what you take as your discount rate. Because sometimes I have seen people take free cash flow to equity and use weighted average cost of capital, and vice versa also. They take free cash flow to the firm and they go on to take KE directly without considering weighted average cost of capital. They don't consider debt. So that should not be the case. So first, what is the company giving you is something that you'll have to analyze. Predominantly, they give you only the balance sheet and P&L. They don't give you the cash flow. We put it in our model and we calculate the cash flow. Even then, you'll have to be careful. But if the company itself is giving you the cash flow, you'll have to be all the more cautious in looking at what kind of cash flow is it, whether it is for equity or debt, or also whether firm debt is also included in it, that cash flow. Now, free cash flow to the firm is pretty straightforward. You include your debt holders, what the company is earning for the debt holders also inside it, which essentially is interest and principal repayments. You have included in it, that becomes your free cash flow to your firm. Now, this is your primary input, which we don't look at much because the company is giving. We have to look at it from this angle to make sure that the data input is right. Now, moving on. The second thing, there is an explicit period and there is a forecasted period, which is the terminal period. Now, what happens is, in a lot of cases, and predominantly, we take on instruments to be valued for an indefinite or infinite period of time. So an equity, we expect it to go on forever. So the company is going to give us a maximum of 5 years. That's what we expect. 5 years of projections we are going to have. We calculate the discounted value, and then the last year, 5th year, we are going to look at the future for an indefinite period of time, what is going to be the value, and we are going to discount that. But mind it, there are certain companies, certain instruments, which needs to be valued only for a limited period of time. Might be 3 years, might be 6 years, might be 10 years, and then they don't have a terminal value. They don't have a terminal value. That becomes a question mark. How do I proceed with it then? Should I calculate for 5 years only and then calculate a terminal value? No, absolutely not. Doesn't require that way. If there are special purpose vehicles, the entire existence of that vehicle is only for a limited period of time. Let us say 8 years. I'm doing a valuation for a company which will exist only for 8 years. given there are 4 contracts and the 4th contract ends at the end of the 8th year from here on. 2000, and let us say if we are in 2024, it ends in 2032. That's all. The company's cash flows are going to stop there. And if somebody wants to buy it, only the 8 years cash flow is something that I'll have to consider. There are no dividends. There are no retained earnings. It's going to be, the company is going to earn money, pay its dividends. And then at the end of 8 years, it's going to cease. Unless otherwise, at the end of the 8th year, some new operations come, which the management has no clue about. They do not expect it to exist now. Now, these kind of situations, terminal value and growth, you don't have to consider at all. Ask the management to give you the records for the entire 8 years project, for the entire 8 years, though we reliable estimates is only for 5 years, because it is only contract based. They can very reliably make an estimate for the entire 8 years, calculate the profits, calculate the cash flows, and with that cash flows you can discount and you can move forward. You don't have to go on to calculate only for 5 years and do a terminal value calculation, which essentially in the terminal value will calculate only for 3 years, which is again twice you're doing the same job. Try to do it for 8 years, close it. So this is these kinds of valuations do exist, where the explicit period is the only period that you consider. But apart from that, the majority of the valuations that we do, we are going to do for instruments which are going to be there for time infinite, where we take predominantly 5 years projections, do the valuation, and from 5th year onwards, we calculate something called as the terminal value. And for calculating this terminal value, we calculate the growth rate. So what is the expected growth rate and how do I find out? Now, there are 2 basic methods to calculate growth. The first one would be the historic approach. Look back at the past. How did the company grow in the past? It made 10 rupees profit the first year, then it made 20 rupees profit, then it made 30 rupees profit. How is the growth happening? It's halving every year, but it is going on a consistent basis. Let us say it is growing at say 5% or 10% every year. It has grown for the past couple of years. Look at that and you take that as the growth rate for the after 5 years is going to grow at the same rate. That is one way of looking at it. The second one is to look at the market. You look at the company's information. The company is going to come and tell you, the management is going to come and tell you that we'll be growing at 7% from then on. We are going to grow at 6% from the 5th year onwards. So this is the company's management is the most informed person about the company, at least. So they are going to give you some information that can be considered. The second one would be the market. You look at the market. The market, they have a consensus. There are a lot of people who are going to follow this company, this particular sector, and they will be having a consensus as to what is the rate at which the company is going to grow or the sector is going to grow. You borrow data from there of people who are following the company. You're going to borrow. Okay. So that data you're going to pull up. So these are the broadly, these are the 2 data sources that you have for expected growth rate. Now, the important thing is the unsaid rule is that your growth rate cannot exceed the return of income that you are expecting from the particular asset. Because the moment your growth rate is exceeding the return on income itself, then what happens is your entire terminal value formula goes for a toss. Free cash flow for the 5th year into 1 plus growth divided by KE minus G. When KE is lesser than growth rate itself, then you have a denominator with a negative value, which is going to cause you a lot of trouble. So growth rate cannot be more than the return on income. That's an unsaid rule. We don't usually do that 100% because it's going to be for an infinite period of time. Nobody can keep doubling it for an infinite. Probably next year they will double. Next year they'll grow at 50%. But at some point in time, they'll have to come down to a normal value. You can use, in case if you feel that today it is doubling and I have to end up with somewhere around 5%, use a H model. H model for 10 years, 200%, slowly you decline it to 5% and then move on. That is one method. H model, you can just go do a quick Google search. You will be able to find out what H model is. That model you can apply and move on. But that being said, the final terminal growth that you are looking at, usually for longer terms, we'll be taking at the sector specific long-term growth estimates that are there, which are made by people who are following the sector, medium term. And then the GDP growth of the country, that can be taken. That is the maximum level that you can grow on a longer term. If GDP of India is going to grow at 5%, you're saying I'm going to grow at 20%, 30%, not going to happen. At some point in time, sectors are going to realign and it's going to go at that 5% only. Your average would be settling down at that 5%. So you'll have to cap your terminal growth rate at some point in time to somewhere around the GDP growth. So this is something, again, very important that you'll have to take into consideration. Now, moving on to the relevant discount rate. Now, we saw cash flows, we saw growth rates. Now we'll have to look at the discount rate. Discount rate, again, weighted average cost of capital or cost of equity. Which one should I take? It depends on what the management has given you. If they have given you free cash flow to the firm, what is available to the company as a whole for both equity and debt holders, you have been handed over. Your discounting should happen at weighted average cost of capital. In case if equity holders cash flow alone is given to you, what the equity holder is expecting would be KE. That alone you will have to use for discounting. So pretty straightforward. Just note it down somewhere so that fundamentally after your article assistant or your assistants do the calculation, just make sure that they have taken FCFF and correlating WACC, or they have taken equity FCFE and correlating cost of equity, and not the vice versa. They have not interchanged numbers anywhere. Just make sure that it is happening. Otherwise, what happens is if you take FCFF and if you are using cost of equity, your value would be high. If you are taking FCFE and if you are taking weighted average cost of capital, obviously debt's value will be higher. So your WACC also will be higher. Then you will have a lower value than expected, which again would cause serious troubles in your valuation. If I'm going a little fast, wherever you want, you can stop me. Sometimes I tend to run through the concepts because certain things are I consider moving fast so that I can catch up some time at the last for discussion. But if you find it difficult to understand because of my accent, stop me. I'll go a little slower. Now, the main points are as related to the other factors are considered there. The main context comes in as the discount rate, where everyone has doubts. Cost of capital, RF plus beta into RM minus RF. This formula everybody is clear, but where do I pick up the data for risk-free rate? What is risk-free rate? What is beta? What is premium? Market premium? These are the information that we are supposed to know as valuers. Now, risk-free rate. What is risk-free rate? It is simply put, the return you can expect from a risk-free asset is a risk-free rate. Very simple, sir. It's already defined. What are you defining here? It's already there. Risk-free rate means whatever you get from a risk-free asset. But then, when we say risk-free, what is free of risk? The amount that I've invested, whether the principal, whether it will return or not, or the interest that the principal is supposed to earn, what is risk-free? I've invested 100 rupees. Whether the return of 10% that is promised to me or 5% that is promised to me, whether that 5% is guaranteed or the principal of 100 rupees that I gave, that is guaranteed. This is the question that comes to our mind. What is risk-free? Return of capital, return on principal, or return of the principal itself? Now, when I'm saying a risk-free asset, both are guaranteed. The principal as well as the return that is promised on the principal, both are guaranteed. Only then it will be called as a risk-free asset. Now, if there is no risk, then how can there be a return at all or a reward at all? That is the question that we have in our mind. No risk, no reward. If there is no risk, if it's a risk-free asset, why would anybody pay any return to us? How can I expect a return at all in the first place? That becomes the question. Now, in risk-free assets also, we carry some risks, which are inherent risks. External risks are not there, but inherent risks are available or embedded inside the risk-free asset itself. What are those risks that are embedded, which we don't consider as a specific risk? Number one is your inflation risk. There is an inherent risk This is an inherent risk, and it goes hand in hand with the currency. You have invested 100 rupees and you are getting 5% return. If the inflation is going to be 6% or 7%, every year that you're holding that particular asset, 2% you're losing. Inflation risk. Default risk. The country itself can default on the currency, on the bonds it has issued. Happened multiple times in the past. Good examples: Uganda, Zimbabwe, multiple countries, they have defaulted on their bonds. So default risk is there inherently. What we can do is probably we can look at S&P, we can look at multiple other rating agencies which rate countries, take the default spread that is given by that particular agency and remove it from the risk-free rate of that particular country. Liquidity risk. What happens is, I hold an asset, but I am not able to sell it immediately. I'll have to hold it on for the next 2 years, 3 years. What should I do? I should choose, for choosing a risk-free asset, I should be choosing a highly liquid instrument so that this liquidity risk is negated. And in interest rate risk, the interest rate risk, as it is, as I can put it this way, I purchase a particular bond which gives me, let us say, 100 rupees, 1000 rupees I buy it for, it gives me 100 rupees every year. Next 5 years, it gives me 100 rupees. But when I try to calculate the internal rate of return, I usually take the 100 rupees at the end of 1 year and I discount it. I assume that the 100 rupees that comes at the end of first year, second year, third year, fourth year, and fifth year can be reinvested at the same rate of 10%. But there is a high possibility at the end of second year or third year, the interest rate environment might change, can change. And what happens then? If, let us say, it drops from 10% to 5%, the IRR goes for a toss. Therefore, what should I do? I should consider only zero coupon bonds, where the invested money will be reinvested in the same bond itself. Instead of being handed over to me and I go on to find out an investment at 10%, it will be reinvested in the bond itself. So at the end of the day, after 5 years, I will be getting a return. So this is the zero coupon bond effect. So these risks are inherent to risk-free assets also. Now this is a graphical presentation. There are countries like Brazil, Kenya, and South African rand, where we can see that the risk-free rate itself is somewhere around 14.5%, and other countries it's about 9%. Let us say the US, your risk-free rate is somewhere around 3 to 4%. I'm just trying to place India here. India is here. India has somewhere around 5.5 to 6%. Interestingly, if you note, there are countries like Swiss francs, currencies like Swiss francs, the Czech Republic, and Japanese yen, which have negative risk-free rates also. What does it mean? So what does it mean when we have negative interest rates, risk-free rates? It means that when you take the money to the government and you want it to be risk-free, you keep the money risk-free, then you have to pay more to keep it risk-free. So if I deposit 100 rupees, probably 5 rupees will be taken away or 1 rupee will be taken away, and I'll get only 99 rupees back for it to stay risk-free and hedged from any inflation-related factors. Now, this is also possible. We'll have to just make sure that we are taking the risk-free rate based on the currency in which you have the exposure. So, example, the free cash flow, it can be an Indian company, but all its operations can be from Japan. Then what risk-free rate should I take? I cannot take India's risk-free rate. I cannot take Indian government's bonds. I should take only Japanese yen-denominated bonds, risk-free rates. If I have exposure in, let us say I have exposure in US and Japan, what should I do? I should take a weighted average of the risk-free rate from Japan and the US. So it's not, usually when we calculate risk-free rates, we take the Indian company, Indian risk-free rate, directly we move on. That's not how it's supposed to happen. Look at what currency in which you have the earnings. They might have converted to INR, that's fine. But before converting, you do all your calculations in that currency itself. And finally, whatever value that you arrive, then you get it converted. So Your free cash flows in independent currencies needs to be calculated. So I have $100 in the US. Let us say 100 rupees in INR, and then in euros I have 100 euros. Do all your calculations. Calculate the risk-free rate in US dollar. The US dollar, what is the risk-free rate? For the European euro, what is the risk-free rate? For India, what is the risk-free rate? Calculate separate rates. Do the calculation, do the discounting model separately, and then you consolidate as a value. Don't bring everything into INR and calculate the INR risk-free rate, INR market premium, and try to calculate. Do the separate calculations and then you bring it in. So I think previously I said you'll have to average. Don't average it. Probably I slipped it there. You'll have to separately make the calculations, and then finally you bring all the values together, convert it into value. At value level, you calculate into INR and you present it. That is how you'll have to move forward. Now, takeaway here is pretty much we have covered it. Choose the yield of the most secure asset, which is denominated in the same currency as the revenues of the company. Typically, the government issued securities, so the T-bills or the G-SECs, you can go ahead and take them. Ascertaining risk-free rate for each projected period. That's again, this is, I told you, geographically, currency-wise, you go on to calculate for different countries, different currencies. Then risk-free rate can also differ from period to period. For 1 year term, there can be a different risk-free rate. For 3-year term, there can be a different risk-free rate. And 5-year term, you can have a different risk-free rate. Now, if you calculate the different risk-free rates separately, and for each year you have a separate KE, it's okay. You can do it. Calculate the risk-free rate, market premium, etc., for 1 year, and then for the second year, what would be the risk-free rate? What is the KE? Third year, what is the risk-free rate? What is the KE? You can calculate and apply those cost of capital for the separately given separately given free cash flows. You can calculate it, but it's a long run process. It will get too grainy, too there are a lot of nitty-gritties that get involved that you might miss out on a lot of things. Rather take a long term, let us say 10-year G-Sec rate, 10-year T-bill rate, go ahead and take that and you incorporate in your model. Rather than taking individual risk-free rates for each year separately, take the longest possible risk-free rate that is available, incorporate it in your model. More or less, you will get it will get averaged out over a period of time. It will get averaged out. More or less, you will get an averaged out number, and then arrive at the default spread using the ratings of the country, using the currency. There is Moody's, there is S&P, which do a default analysis at the country level. A lot of company level analysis also they do predominantly, but at country level analysis also they do. These spreads, default spreads, whatever risk-free rate that you have calculated, go ahead and reduce it. If I'm expected to do 6%, default spread you will have to add or remove, and then you find out what is the actual risk-free rate. You will be able to find out. So you have to adjust it to find out the risk-free rate. So risk-free rate contains all these things. You'll have to keep it in mind and then apply it. Let's jump on to equity risk premiums. Now, when it comes to equity risk premium, the moment I say premium, it's over and above something. What is it over and above? It's over and above the risk-free rate. So I don't take any risks. What is the return that I can expect? I'm taking the risk on investing by investing in your company in equity. What is the extra that you're going to give for investing in your company as a equity? So the return expected from an equity investment over and above the risk-free rates. Simple definition. What is the difference between equity risk premium and market risk premium? Now that we have non-stop, I've spoken for half an hour. I think I'll give you a break somewhere around 7. For 5 minutes, I'll give you a break because I know 2 hours is a stretch. Probably around 6:45, 6:50 itself, I'll give you a 5 minutes break. Now I want you to participate. Tell me what is the difference between equity risk premium and market risk premium. Anybody who wants to give it a shot, please go ahead, unmute yourself and give it a shot. Probably if you have attended one of my previous sessions, you would know. Still, you can get, you're still eligible to give it a shot. Yeah, go ahead. Anybody? What is the difference between equity risk premium and market risk premium?
Market risk premium is on a pool, on a portfolio.
On a portfolio. Okay. Okay. And what is equity risk premium? Okay. I think it's broadly it is right. So in practice, we will not be able to calculate. So when I have one equity in hand, one particular company in hand, and I would want to know what should I pay as premium for this particular company, that is equity risk premium. But I cannot do that. If I know that, how much am I supposed to pay as a premium, then I already know the KE, cost of capital for that particular company. If I know the cost of capital, if I know the risk-free rate, whatever is the difference, it is going to be the premium that I'm going to pay. It's straightforward. I don't know what is the cost of capital. That is the reason I'm calculating this risk premium. Therefore, what is the closest thing that I can look for an equity risk premium is the market risk premium. So essentially, I look at the market, all the assets, equity related assets in the market, I take it and I substitute in the place of equity risk premium. That's going to be your market risk premium. So in the market, instead of investing in risk-free asset, if people are investing in equity, what is the premium that they're expecting from the equity is going to be your market risk premium. What we are doing is taking market risk premium. Because we don't know ERP, we are going to put MRP in its place and go ahead and do the calculation. So in practice, individual risk premium of a company is not purely ascertainable. So we use the market risk premium as its substitute. So in essence, the return expected from the market less the risk-free rate is going to be your equity risk premium. It's not purely equity risk premium. You're substituting the market risk premium as your equity risk premium. Now, this is all the more reason why you use beta. Otherwise, risk-free rate plus equity risk premium, if you already know by whatever methodology, if we come up with a new methodology, you calculate the ERP, risk-free rate plus ERP would directly give you the cost of equity. Because you're substituting apple in the place of oranges, you'll have to do an adjustment, which is called your beta. You have a fruit basket. You're taking apple. What is the consistency of apple? Apple is going to be sweet. I'm taking sweet, but we take the fruit basket, which has bananas, which has oranges, which has apples. I'm going to replace it on behalf of apples. Then I figure out a way to make sure that everything is sweet, but what kind of sweetness is the one that I'm looking for. I'm going to use a beta factor to make sure that this equates. This is diluted down to look like an apple. So that's the idea that we are trying to bring out here. Now, moving on, how do I calculate ERP? Essentially, I'm calculating MRP here. Look at the historic approach and the implied risk approach. Historic approach is pretty straightforward. The returns the equity market was able to make over a long period of time, you look at it. You make the calculation. How much is the market able to make as return? And we make an assumption that that's the return that it is going to make in the future also. That's the historic approach. I look at Nifty. Nifty has made 15% over the past 20 years. I take as much as possible. I'll take the longest tenure as possible. The NSE and BSE, which are Indian. I'm going into Indian stock exchanges here. If your currency exposure is in foreign currency, let us say you have US dollar exposure, you cannot take NSE BSE. If your exposure is in foreign currency, go ahead and take that currency related stock exchange index that is available. Go ahead and take that. If you have euros, if you have pound sterling, go to the London Stock Exchange. If you have some Japanese stock exchange, whatever is available, Nikkei is available, take Nikkei. So whatever is the currency in which you are having the free cash flow, related to that, whatever is the index that is available, you'll have to take. And maximum possible timeline that you'll have to take. In India, at least from 2000 onwards, we have consistent data. Before 2000, the data is sporadic, it's not reliable, because 1992 is when we had our liberalization. So 1992 is when we had our liberalization. The Capital Control Act became Capital Issues Act. So from then 1992 to 2000, the numbers are choppy. 2000 onwards, you have good numbers. 20 years estimates would throw you a good number. But if you go to the US or other countries, probably you can go down to 30, 40 years also. Historic approach. Next comes your implied risk approach, where you don't look at the history at all. You look at the present. You make estimates of the future, and then you calculate what is the market expecting from the future from this company. So this is pretty much the reverse of what we are doing. We are having all the data and we are trying to find out the value. Here we are looking at the index. We are looking at the index to be so much value. We are making projection as to what is the cash flow that is going to come from this index the next 5 years, 10 years down the line. Make a terminal value calculation also. We have the growth, all the other expected numbers from the market, we pick it up. Only thing that we don't pick up is the return that is expected, because that's what we are trying to figure out. And then you make a reverse calculation to find out the rate of return. Now, historic approach, pretty straightforward. Identify the market index in the currency matching the revenues or free cash flows projected in the model. This is very, very important. Do the calculation in that currency. Ascertain the CAGR of the market index for the longest period possible. Then calculate the dividend yield of the market index for the matching period, because dividend is not included in your rates. If index is going to move from 10,000 to 11,000, this is after dividends. So dividend you'll have to separately calculate, and then ascertain the average.
I think
You have a question? No. So ascertain the average historic risk-free rate for the same period of time. If you are calculating the MRP, market risk premium, in a historic approach, take the historic risk-free rate and then you negate it. Okay, so that you will have to negate it. So CAGR value plus the dividend yield that you have minus the risk-free rate is your proxy equity risk premium. It's the proxy for equity risk premium. It's your MRP, your substitute. Now, going on to the implied risk premium. So, simple example I've taken, because when I put it on text, when I write it down, I'm able to understand. When I reread it, it becomes all the more confusing for myself to understand. So I have borrowed this particular example from Ashwath Damodaran, which makes perfect sense for me to explain also. So Sensex in 2007 was, let us say, about 15,446. The dividend yield expected on the index, all this is future focused. Nothing is past. It's not past data. What is expected dividend yield as a consensus from the market, whatever is there, is 3%, 3.05%. Expected growth rate for the next 5 years as per the market expectations, somewhere around 14%. Growth rate beyond 5 years is somewhere around 6.76%, set equal to the risk-free rate that is there. Now, solving for the expected return, this formula, I hope everybody understands. Predominantly, what we try to do is we have this variable as the unknown. The return that you are expecting when you are doing the valuation is a known factor. We do this entire formula. This is your terminal value calculation. Everything else is your FCF of FE 1, 2, 3, 4, and 5. And then all these are known factors. We calculate, we do the mathematics for arriving at this 15,446. But here, unfortunately, we have 15,446, but we don't have the other numbers. Don't try to do it. Okay. Don't try to do it manually. Use the solve function in Excel. Put this in Excel. Use the solve function. You'll be able to find out the expected return on the stock is somewhere around 11.18%. The implied risk premium for India is you reduce the 6.76% of growth. The risk-free rate that is available, which comes to 4.42%. Now, moving forward, as I told you, because we are using a market risk premium in the place of equity risk premium, we'll have to make an adjustment. We want an apple, but we don't know where we want apple juice, but we have a mixed fruit juice. We have taken that and we are trying to explain how one apple fruit juice would be. So we have mixed fruit, but we'll have to extract out what is the taste of apple fruit. So that is the reason we are going to use this beta. So as promised, we'll take a quick, let us say 3 to 5 minutes break. We'll stop here. I will be available. Everyone else can take a break. Any questions that you have so far, whatever we have covered so far, you can stop me here and you can ask me questions. I'll wait here for the next 5 minutes. So we'll resume sharp around, it's 6:50, 6:55 we'll resume. Till that time, you have any questions, you can go ahead and ask. I'll go back to the slide and I'll explain. Okay, I don't see any questions. So let's.
Sir,
Yeah, go ahead.
Sir, currently, if we are working and we need to arrive at the market risk premium in India. So, on what basis can I arrive at that? Where do I actually compute this? I can consider risk-free rate. Yes, I can obtain that. How do I get the market risk RM? My RM is the issue.
Okay, market risk premium. Before that, you'll have to calculate the market. So the value, the expected return from the market is something that you're going to figure out. So there are two methods. Usually we follow the historic approach, where very easy, you go ahead and take whatever is the historic return that you get from the market. You add to it the dividend that you yield that you get. So there is a CAGR formula. You take day on day what is the increase in value, as much granular as possible. We take that and we calculate what is the dividend yield from that particular asset, particular market. So dividend yield plus CAGR formula driven value that we get, that would be the return that you can expect from the market. From that, you will reduce the risk-free rate. It's pretty straightforward. But when you want to go a little on the record as to actually calculate, because all my cash flows are going to be in the future, taking a past return and just making an assumption that it's going to continue in the future, I don't want to do that. I would want to know what is the actual value. Find out what is the Sensex value as on the date you're doing the valuation. So that would come here. That is the 15,446. What is the dividend yield that is expected from the market? Published information is available. For the next 5 years, this would be the dividend yield that you can expect. Go ahead and take that yield as a percentage here. Then what is the expected growth rate for the next 5 years? You have again published information for the sector, for the particular market. This is where it is going to be there. There are a lot of research that has happened. At some point in time, we'll have to, at least we are relying on what is in the future. We are relying on it. Based on estimates, we take that information and then we go on to calculate what is the, so we put it in this formula. In this formula, one thing that we are taking is the growth rate beyond year 5, we are taking it as the risk-free rate. At the terminal growth, we are going to take it as the risk-free rate that we are having, because it is already available information. That is the return that we are expecting. You take on that information and you solve for R, which is the return. So if taking into consideration, this is the cash flow, this is the growth that is expected, and this is the point, Sensex or Nifty point, this is the index value as it stands today. Then what is the return that the market is expecting based on today's return, today's market? So if Nifty, I think it's somewhere around 21,000, 22,000. If it is 22,000 today, and based on the composition, this is the return that I will get from the market. What is the market expecting out of it? Is it expecting 12%? Is it expecting 15%? It is very much available. That information can be brought in.
Right. So on the date of valuation, that's what's that
Correct.
date is okay.
Correct,
Okay,
correct.
I can substitute it into this
Correct.
this formula and obtain.
Correct. On the date of valuation. And this index should be in the currency in which your free cash flows are.
Okay, sir, understood.
Okay. Right. So I think we will restart now if everyone is back. So we'll pick up from where we left. We're going into beta. I told you beta, the existence of beta is because we are taking market risk premium in the place of equity risk premium. So we are going to take the beta. It can be beta, simple terms, you define it as the change in the securities return in relation to change in the market's return. Now again, proxy for a proxy is going to come in now. Because I'm not able to find out equity risk premium, I've taken market risk premium. To bridge that gap, I have brought in the factor called beta. Now, the problem is, if I know that if the equity is moving in one direction with relation to the market, I can find out the beta for that particular stock. But most of the times what we are valuing is not a publicly traded entity. It's going to be a private entity. So when market information is available, when the index information is available, I unfortunately don't have the equity information because it is not listed. If I know what is the value of the particular stock today, why at all am I doing the valuation? So what I do is I go for the nearest estimation again, just like as I did with ERP and MRP. Again, I'm going to for the nearest estimation. But as a formula, for a given change in the market return, how many times the return would the security yield? So change or delta in security return divided by the delta in the market return is what we take here. In real life, what we do is we take the sector in which the particular security is there and we replace it in the place of the actual equity. So from MRP, we are taking it to the sector, and from the sector, we are taking it to the particular equity or specific company that we have in hand. So a couple of items that we have in hand, because we are having change between the security and your industry in which your security is placed, the base component, which is the nature of the business, will come into play. There are a lot of operating leverages. Operating leverage is the allocation of your funds. How much of it is fixed cost? How much of it is variable cost? That is operating leverage. And then finally comes your financial leverage. How much of your equity funding is debt? How much of your funding is equity? That comes into play. Based on all these three factors, your data is calculated. The base component, what sector your company is into, if you have a cyclical company will have a higher beta in comparison to a non-cyclical company. Luxury goods selling firms will have higher beta than essential goods company. Business selling higher priced goods or services will have higher betas than business selling lower priced goods or services. Growth firms usually have a higher beta. Now, I have just read what is written. I'm going to give you an example. Now, usual example that has stuck with me for the past 3 years, right from the time we had COVID. How many of us during the COVID times, hearing what is going to happen, what's not going to happen, we stopped purchasing luxury goods between 2020 and 2021. We stopped buying luxury goods. We did not buy iPhones. Most of us leave the ultra rich people who are anyway having a lot of money that they're going to spend in different ways. Most of us, we would have stopped making luxury payments between 2020 and 2021. But how many of us stopped having food? After COVID, a lot of us, now that we understand that the market is resuming, my income is not going to get affected, world is going to go on as normal, we went on to buy luxury items. We bought more expensive phones. But how many of us started eating, instead of 3 times food, how many of us started eating 6 times food? Probably we would have had a better quality of food, but we did not go for having more food. Luxury, that level of luxury would increase, but the basic component, the rice, would not increase. Probably a better quality of rice would have come. So there are certain goods, irrespective of whatever is happening in the market, a minimum consumption would obviously be there. Those are the essential items. So even if the market is falling down, people have to have food, people have to have shelter. The basic essentials, they are not going to go down. The essential groceries still had a market there. So even when the market plummeted, the value of these stocks remained the same. In fact, there were cases where it was there was an inverse proportion also. The moment people heard that there is going to be a lockdown, people stocked up on all these provisions. And actually, when market plummeted, the stock value of these provision-related companies, it started going up. But when the market went down, the luxury goods related stocks, they started to plummet even more. They were the actual driving factor behind the plummet in the market. IT companies, they plummeted. When there is a recovery, the recovery is bullheaded by these luxury item companies. But even then, there was an upshoot in the other essential goods. It was not to the extent of the luxury goods sector. So the change that you can look at when you compare the market and the particular company, the companies which are into luxury goods production, they are the driving factor for both the increase as well as the plummet. So they will have a higher beta. They have a higher change. When the market rose up by 5%, they rise up by 10%. When the market goes down by 5%, they go down by 10%. There is a doubling effect. So it is 2 times the market. The beta for that particular luxury sector companies would be 2 times. When you compare it with the essential goods, where it can be the essential goods, the beta can be somewhere around, let us say, 0.8%, where when they go up, they will also go up. 10% growth, you can look at 8% growth here. And when they go down by 10%, you can look at somewhere around 8%. They might go down. So this is the base component. What sector are you going to be in? That makes all the difference. Now, in fact, you take startups. When the market is good, when money is available, all these companies grow up like anything. When there is a tighter market crunch, the money is not available due to some bank action. Even if the market crunch is going to happen, the moment SoftBank, or there was this other bank, I forgot its name. This bank, it's not SoftBank. There was this bank, regional bank in the US. When they collapsed, all the money that the startups had, they have invested in that bank. When they froze the assets of that bank, automatically, a lot of startups, they had all the money that they had, they have invested in that particular company. And a lot of startups failed because they did not get the money in time. I forgot the name. If you remember it, please put it on the chat. That these kind of situations happen in startups. Therefore, they have higher beta in comparison to normal other companies, which are normal companies. Now, operating leverage, businesses that have fixed costs or infrastructure costs, they have higher beta in comparison to companies that have flexible or variable cost structures. If you have bought an office, if you have rented your office space, let us say for 1 lakh rupees in the heart of the city, and COVID strikes, irrespective of what happens, at least for me, the landlord did not reduce any rent. I had to pay the entire rent. But if you have a co-working space, instead of paying for entire 10 seats, you could have paid for 1 seat, or you could have said that I am not occupying the seat for the next month. I will not come from April onwards. April, May, June, you don't bill me. So companies which are invested in infrastructure and fixed costs more will have higher beta in comparison to companies which have variable cost more in place of the fixed cost. You have a hotel. If you remember that point in time in COVID, if you have a hotel and if the hotel is owned by that particular company, COVID, nobody is going to occupy. You're going to upkeep. You'll have to spend for maintenance and you make no earnings. But if you had it on rent, you could have probably negotiated and you could have at least 1 or 2 months you could have gotten a waiver. Financial leverage. How are you funded? Are you funded as debt or equity? When an investor invests in debt of a company rather than equity of the company, he does so. Why? Because he wants to minimize his risk. Now, this risk is passed on from the debt holder to the company. And from the company, who is the company? The equity holder. So the company will pass on that risk to the equity holder. So when a company takes debt funding, its risk component increases and the equity holders are compensated with the leveraging effect. With higher risks, good times become great, bad times become worst. And this magnifying impact of financial leverage, you'll have to factor it inside your beta. Interpreting beta can be equal to 1, it can be lesser than 1, it can be greater than 1. If beta is equal to 1, it essentially means that your stock moves in tandem with the market. So market goes up by 10%, your stock also goes up by 10%. If your beta is lesser than 1, it essentially means that it is not the driving factor, but it is one of the factors that is pushing, but it is not the driving factor. It suggests that the stock is moving in the same direction, in the same proportion to the market, in the same direction, but not in the same proportion, lesser proportion, and it is the market influence is relatively weak. But if your beta is greater than 1, it means that it not only moves in the same direction, it is one of the pushing factors behind this market to move up. So if TCS is growing, automatically the market, it has the potential to move up the market itself. So those are the companies which have beta of greater than 1. If blue line represents your market, then if your beta is lesser than 1, essentially means that when the market goes up by 1%, your stock goes up by somewhere around 0.25% or 0.5%. When the market comes down by 1%, your stock is going to go down by 0.25% or 0.5%. When you have a beta of greater than 1, the market itself is going up by 1%, you can expect your stock to go up by 2%. Because it is one of the driving factors. So the average between this red line and the yellow line is going to be your market. So that is the takeaway that you will have. The average of the red and the yellow line is going to be your blue line. There are going to be obviously certain items which are going to be higher and certain items which are going to be lower or from the average. All the items that are having which are above the blue line are going to be having a beta of greater than 1. Items which have a which are going to be below the blue line are going to be having a beta lesser than 1. Is there any possibility that there can be 0 or negative betas? Theoretically, negative and 0 betas are possible. 0 beta is not an anomaly. Look at fixed deposits, which is not an equity instrument, but still, if it is so disjointed, there are certain assets which are so disjointed from the market, then automatically those instruments will have a 0 beta. You can, though there are not much products that are available which has 0 beta, you can construct a particular portfolio in such a manner that it has both negative as well as positive betas, the cumulative view of which you will have a 0 beta. That is possible. Now, when I say that, I also have picked up the concept of negative beta. In reality, negative betas are also possible. It's very hard to find. It is very, it's not, you don't come across it very easily, but it is there. So there are, when you take a natural example, you take gold. When equities go up, gold usually tends to go down. And when equities go down, people will start buying gold as I mean, to make sure that they are not losing out, they start investing in gold. When their times are not good, people don't invest in equity, they invest in gold. So markets go down, gold goes up. Now gold directly cannot be listed in the market, so you cannot equate it, but there can be companies which trade in gold. There can be companies which mine gold. Those companies, when you look at it, they tend to operate in a different fashion. When the markets go up, automatically their gold prices go down. It can go down. And when the market goes down, the gold prices go up and these stocks can go up. The long term, it's not going to happen. Long term, you will not have any stock which has a negative beta, because the moment you have a negative beta and the market keeps going up, there is no way market is going to go down for an indefinite period of time. It's always going to go up because there is inflation that is involved. If the market keeps going up and if you have a stock which actually has a negative beta, then it is going to keep going down and that stock is not going to exist. So practically it's not possible, but in theory, for a shorter period of time, negative betas are possible. If the blue line is the market, you have a negative beta by portfolio or as a common individual stock, then when the market goes up by 1%, it might go down by 1% or probably 0.5% or 0.2%. When the market goes down by 1%, it goes up by 0.2%, goes up. Now, zero beta, you don't have an effect. Whatever happens in the market, it's not going to affect me. I'm not going to go up or go down. Whatever is the yield that I'm going to give, that's the yield that I'm going to give. So that's your zero beta. Levered beta versus unlevered beta, this has nothing to do with your conversation on FCFF and FCFE. Irrespective of whether you're going with FCFF or FCFE, because people get confused. Sometimes I get questions. FCFF and FCFE does not influence your decision on whether to go with levered beta or unlevered beta. Usually what happens is you go on to the market, you calculate how it is functioning. So example, I take a couple of stocks and I look at how are they performing in relation to how the market is performing. And whatever beta that I calculate, it will be a levered beta. How is it levered? It is levered towards that particular company. If I take Tata Motors and I look at all the stocks in Nifty, in the NSE, let us say the top 50 stocks, Nifty 50, and I take Tata Motors and I make a calculation of beta. Tata Motors in relation to, let us say, the NSE 50, what I get is the levered beta for Tata Motors. I have to pick it up, unlever it, and then can I directly use the unlevered beta in my company? No, I'll have to lever it towards what is the leverage that I have based on the financial levers that I have. What is the debt equity structure? Based on that, I'll have to lever it and I'll have to apply in my calculation. So broad understanding, and at the cost of repetition, levered beta is a beta of a company which has both debt and equity. Unlevered beta is for a company which has only equity. So all the companies are going to be, the data that you're going to get is always going to be levered betas. Take it, unlever it. You have the formula given here. I'm not going to go very detailed into it because we have another 15 minutes only. So I'll try to complete within that. So levered beta is the beta which has, so broadly saying, when you have, when I say equity is moving in a direction in relation to the market, when there is a debt component that is inside that particular equity, debt has nothing to do with what is happening in the market. So irrespective of the whether the market goes up or down, the debt is going to stay there. The return from the debt that you are expecting is not going to go up or down. Therefore, if it is supposed to go up 8%, because debt is involved, it's going to come down as 6% or 7%. What I do is use this formula where beta unlevered is beta levered into equity divided by debt 1 to 1 minus tax plus equity. I use this formula. I remove the debt component, and whatever is remaining, that's going to be your beta unlevered. And when I calculate the beta unlevered, I cannot directly apply it to my stock, because My stock is anyway having a debt component inside it. Though that company can have 50-50 debt and equity, I might have made it beta unlevered, but my stock can have 20% debt and 80% equity. I'll have to lever it towards that. How do I calculate my betas? Simple methodology would be to go and do a regression model. Different points in time, I'm going to plot the points. I'll be having return from the market, the Nifty index. I'll be having Tata Motors share. How much for every 1% increase in Nifty? What is the corresponding increase in Tata Motors? I'm going to find out. I'm going to make a pointer in the graph, and then I'm going to find out the middle point through regression analysis. Graphically viewing, I'm going to cut these points in the middle in such a manner that it cuts it in the middle halfway through I'm right, halfway through I'm wrong. In either side I'm right and wrong. So the middle ground, the slope that is available, that is going to be my beta. Now, single regression model, can we use regression model at all in the first place? It is inherently inefficient, because when I take one stock, if I am in the motor vehicle sector, and I take it directly comparison, I compare it with I compare myself with Tata Motors, it's not going to make sense. So just don't take one stock, take a basket of stocks which are in that particular sector. Also, regression is subject to something called standard error. If your beta is 1, 1.2, and if your standard error is, let us say, it can be between plus or minus 0.2 or 0.3, it can vary your calculations vastly. 1.2 plus or minus 0.3, that can bring your value down to 0.9 to somewhere around 1.5 or 1.6. That much variation you cannot accommodate in your calculations. Also, the index that is taken as standard might be largely dependent on the single stock, which will skew your proxy beta. An example that usually that is being discussed is the Helsinki Stock Exchange. At the point in time when Nokia was there, the entire Helsinki Stock Exchange was dependent on one stock only, which is Nokia. When you want to work out on a mobile technology company, you want to do a valuation. You can be a very small company, but because Nokia was the predominant player, which occupied somewhere around 70% of the market capitalization of the Helsinki Stock Exchange. If Nokia sneezes, the entire market catches cold. So if you take that analogy, then whatever happens to Nokia, you're going to say that it is going to apply to you also, which is not the case actually. Whatever happens to Nokia it cannot happen to you. You don't have such a close relationship. Therefore, this kind of skewness in the data you cannot accommodate. Therefore, we go for a simple average of bucket of comparatives to improve the quality of beta. In fact, when it comes to beta, because it is a comparative number, you don't have to stick with that particular stock exchange in which the currency you have also. You don't have to compare technology companies with relation to Nifty if you have INR exposure. You don't have to stick with technology companies in relation to the US stock exchange with relation to US currency exposure, the dollar exposure. You can take global exposure because it is calculated as a comparative number. You can take the global number, you can go ahead and apply it. Step-by-step guide as to, you don't have to do it. I'll tell you where to pick up these data. But if you are planning to do a calculation by yourself, this is how you'll have to calculate your beta. Do an in-depth analysis and find out the businesses the target company is currently involved in. Then identify publicly traded companies that are similar line of business. You first find out what this company is doing. Then find out companies which are in the same line of business. Now, this is where the problems start coming in. Tata Motors, every time I give the same example, Tata Motors is into commercial vehicle manufacturing as well as passenger vehicle manufacturing. But when you look at Ashok Leyland, they are into commercial vehicle manufacturing only. So now, how do I compare Ashok Leyland and Tata Motors? Now there is Maruti Suzuki, which does not manufacture electric vehicles, but Tata Motors manufactures electric vehicles and they are planning to go in big time. We don't know whether it's going to work out or not. They are into CNG. They are planning to introduce a lot of CNG related vehicles. Maruti Suzuki is also trying to do it. Hybrid vehicles. multiple, the portfolio gets murkier, the business gets murkier as we go on to analyze that particular company. So look at your company, what kind of business your company does, and is there a possibility that you can split the revenues, and the way in which these companies are performing is something that you'll have to look at. That is the first step, analysis. Next would be a regression beta. Find out the betas for the identified companies. So if I'm in the motor vehicle manufacturing sector, I'll go on to calculate the regression beta for all these companies. Then run a regression to find out the regression beta of each company. Now you take a simple average of the regression beta to arrive at the beta for the sector. Now I take the individual betas for Ashok Leyland, Tata Motors, Maruti Suzuki, whatever is available, motor vehicle manufacturing companies that are listed, and I make a simple average to find out what is the beta for that particular sector. Because obviously for my company, I cannot find out because I don't have the value. For the sector, I'm calculating. Now, the sectoral beta so arrived is a levered beta. I don't have to calculate the unlevered beta at that individual company level. I will calculate the levered beta only. For the entire sector, I will calculate the levered beta. Individually, I will calculate the levered beta. But for the sector level, there will be a percentage at which the debt equity would settle down. So for motor vehicle sector, 70-30 or 80-20, whatever is the published analyzed information that is available, I will use that information to unlever the beta that I have arrived so far. Whatever levered beta that I have arrived, I will unlever it using the debt equity ratio that is applicable to that sector. So that is the unlevered beta that we'll get. Now I have to start doing some base refinement. Adjust the unlevered beta so arrived for operating leverage related matters. So we saw operating leverage, we saw financial leverage, and then we saw base component related matters. We already did the from levered beta. When you are converting to unlevered beta, automatically you are removing the impurities with relation to financial leverage. You'll have to go on to calculate the operating leverage also. Find out usually in that sector what is the fixed cost to variable cost ratio, and then based on the what is your company, the target company, how is the fixed cost versus variable cost, what is the ratio, you calculate the same manner in which you did your financial leverage removal, unlevering. You'll have to do that refinement here also. It can be done in that manner, or you can add a value, reduce a value, but you'll just have to have an idea as to what you are adding or removing. Now, weighted beta. Now the target company can be into multiple businesses. So you have calculated the motor vehicle division. There can be an electric division. There can be a civil division. L&T is into civil construction. It is into information technology. It can be into hotels. It can be into multiple other things. So ITC is into hotels. It is into tobacco, predominantly tobacco. It is into consumer FMCG goods. It is into multiple divisions. So for this sector, you have calculated for one sector. Find out the same manner you apply it for all the other sectors in which the company is involved. So if you are calculating for ITC, FMCG, you should have done till step 4. Hotels, you'll have to do till level 4, and tobacco, you'll have to do it till level 4. And then you do a weighted average based on the revenues from each of the sectors that the company is having. So take the unlevered sectoral betas for all the sectors and find out the weighted average beta by using the value derived from each businesses to the target company as the weights. So what is the value that is derived? What is the revenues that you make? What is the cash flows that you make? Take it as a base, calculate the weighted average beta, weighted beta. So these are not given names. When I'm saying weighted beta, it's not weighted beta. It's for my simple understanding, I call it weighted beta. You can call it whatever name you want to call it. Multiple unlevered betas. If the business composition of the company is expected to change significantly over a period of time, then you can go on to calculate multiple unlevered betas also. So I know that this year 80% is tobacco business, 10% is FMCG, 10% is hotel. But next year I am expecting it 70%, 15%. And the very next year I am expecting 60, 20, 20%. The next year I am expecting 50, 25, 25%. Then this weighted beta can be done at an year level also. For each year, separate beta can be calculated, and multiple unlevered beta can be calculated, which will be kept separately, and multiple years different KE will be calculated for your for your calculations, for your KE calculations. So different KEs will be there, and different every year you'll have to apply all the, for the 5th year you'll have to apply 5 discount rates for each year, different discount rate. So proxy beta, the weighted beta arrived shall be subject to debt equity ratio of the target company. For your company, what would be your debt equity ratio? So you lever it. So whatever we have is unlevered. You are levering it for calculating the beta for your company. It's called the proxy beta. And then multiple proxy betas, same thing applies. Previously, we saw multiple unlevered betas. If you have multiple unlevered betas, then you'll have to go on to calculate the multiple proxy betas. Obviously, in the multiple proxy betas itself, if your financing differs from current year for the next 5 years, you are able to split the current year I'm having 70-30. Next year I'm going to have 60-40, and next year I'm going to, let us say, have 90-10. If I have different projections for the in the future, it's okay. So far, what we have done is however debt equity it is standing today, I'm going to use it directly. And beta, I'm not bothered about it. It's not going to have much of an effect, is what I'm assuming. And we are all moving forward. But when you go and try to calculate in the pure sense, you want to calculate it perfectly, then you'll have to calculate multiple proxy betas based on the financial financing, the debt versus equity for each year. You'll have to calculate, and separately multiple proxy betas are calculated. Finally, you have to also adjust for cash. Just as debt is not going to have an impact in your beta, same way, whatever asset, from the asset point of view, cash is also, other assets in the particular company are going to work, are going to move in tandem with the market. Other assets are going to move in tandem with the market, but your cash is not going to move in tandem with the market. It's going to be zero. It is always going to have a zero beta. You'll have to adjust for cash. What is the cash that is present usually in the market versus what is the cash that is available in my bank account, in my portfolio? I'll have to adjust for this cash. This is called your cash adjusted proxy beta. This is the beta that you'll have to pick up and you'll have to work with. Now, when you're calculating beta, I said you'll have to calculate the beta. You'll have to look at certain things when you're doing the calculations. You have to take the closing stock. Don't take any number. You'll have to take the closing rate of the stocks when you're considering. As much as possible, go into the granular detail. So daily returns can be taken instead of monthly returns or yearly returns. Go to the daily returns. We are not going to work this out. I'm not going to manually work this out. I'm going to load all this information into my Excel sheet. And Excel sheet, 20 years into 365 days is not much of a number for an Excel sheet. It will be able to calculate, apply the CAGR formula, it will be able to easily calculate. Now, financial statements, the financial figures like risk-free assets, debt equity ratio are recommended to be taken from the annual financial statements. You should consider stock splits and bonus issues because that is going to have a variation in your calculations. In case there are extreme events, so I remember 2015 there was some extraordinary event that happened in the Wipro's balance sheet where the stock suddenly went up 10% and then it came back and resumed it in its normal shape. I don't know, I don't remember for what action this happened. These kinds of extraordinary events of going up and going down, you tend to remove it. Extreme stock movements, and particularly when they are in the last fag end, as you stand on that particular day, if there is a COVID related event that has happened and extreme events are happening, when the market has not moved much, your stock has moved extraordinarily high or extraordinarily low, you know that it has happened for some reason and it is bound to come down. If it has gone down, it is bound to come up. If it's gone up, it's bound to come down. Those items you'll have to remove. That is noise reduction that you're supposed to do. Now, alpha, final part, 4 minutes I have. All the beta that we have calculated so far is the non-diversifiable systemic risks in the market. Now, there are certain unsystemic risks that are there, which are diversifiable risk. It is an intercept value that's going to be called as your alpha. It is calculated by comparing the volatility of the portfolio with the benchmark. Market is able to perform, it is able to get only 10 to 20 percentage. I am able to get 25 percentage. That 5% extra that I get is the alpha. In simple terms, we can expect a market-based return for a given undiversifiable systemic risk of the company. The excess return that I'm able to make in comparison with the market is going to be called your alpha. Usually what happens is you have a portfolio manager, you give your money to the portfolio manager, you're going to show that the market has performed, it is able to get 12% return. See, I made you 2% extra return. I'm going to charge you a commission on that extra 2%. For that purpose, alpha is there. Can I use this alpha in my calculations? Can I say that this stock it will perform 2% or 3% better than the market? The management is saying that it can perform 2 or 3% better than the market. Can I take that into consideration and use that for making the valuation? No, you cannot use alpha. Alpha is an intercept value only. It's a post factor event. You are not supposed to add anything apart from the data that is available, which is risk-free rate, beta, and your RM minus RF, the premium. You're not supposed to take alpha. I would suggest, even in cases where you have diversification risk, you have liquidity risk, control risk, don't apply it at this level. At this level, you can substantiate on all the other grounds, go ahead and make the calculation. At the value level, once you use this cost of capital, and when you finally arrive at the value, let us say you arrived at 500 rupees, and you think there is a control related premium that you would want to add, or discount that you would want to add, reduce, liquidity related premium or discount you would want to do it at the value level. At from 500, you can reduce 10 rupees or 20 rupees. A percentage, you can reduce it from the value and attribute it towards the specific company specific item that is available. This is a generic slide that I conclude my sessions with. Enterprise value would be the value of the business using discounted cash flow method, value of the firm's operations. Then you add non-operating assets. So whenever you do the calculation, the free cash flow, based on that, when you calculate the enterprise value, it is based on the operations, core operations of the firm, whatever value you arrived, it's called the enterprise value. Now, when you add non-operating asset, Tata Motors has a business. And apart from that, it also has a piece of land, let us say in the US, which has nothing to do with operations. It has just invested that particular on that particular plot of land for the purpose of appreciation in value. That is not going to add value. That will not be included in my enterprise value. So separately, I will value it from a land and building valuer, add that to my valuation report. I'll add that to the enterprise value to arrive at the firm value. Now, from the firm value, if you are using FCFF, you'll have to remove the debt value, and then you arrive at the equity value. So, in my presentation, I hope you have a lot of questions which I can go ahead and understand. Because it's all about me understanding. I took all the efforts for your questions. So go ahead and throw out the questions to me. As much as possible, I'll try to answer and address your questions. And in that process, let me try to learn something. You need a break for 2 minutes before you start asking your questions. It's fine. I'll need a 2 minutes break. I'll just resume in 2 minutes. Yeah. So any questions that have come up in the past 2-3 minutes break that we had, ready to answer? Otherwise, we'll look at some practically where we take some data. Let's discuss about it. I leave it for 1 more minute for any questions. No question? Yeah, go ahead. Mange sir or madam, I'm not able to hear you.
Hello, good evening.
Yeah, good evening.
Thanks for very good session.
Yeah.
And one thing just I wanted to ask is, see what you are referring as a firm value, is it not the enterprise value?
Firm value and enterprise value. Let me quickly go back. So this is the slide that we are talking about, right?
Yeah.
So when I'm saying enterprise value,
Yeah.
I'm talking only about the firm's operations.
Mm-hmm.
When I'm saying, so the firm includes the enterprise of business. So I'm talking about the business of the firm. Business of the firm is going to give me some value, that is the enterprise value.
Yeah.
So these are not defined terms. This is the term that I have. So and the firm has a business which is an enterprise, and there is a value that I associate with the operations of that particular business. So
Yeah.
that is going to be the enterprise value. When I'm saying firm's value, I'm taking all the other assets that are also available. So which are not related to the operations. So example, cash that is parked as fixed deposits.
Yeah.
The company would have made some investments in stocks. The company would have invested in land, gold, paintings. It could have invested in other items which is not related to the business.
Yeah.
But somebody is going to buy shares in the company, or if the company is going to distribute all its assets towards the debt holders and equity holders, these assets are to be included. Therefore, when I'm saying firm value, I add all these non-operating assets also. Along with the enterprise value, I add these non-operating assets also.
Okay. Generally, what I have seen is what you are telling, the enterprise value that is called as a business value. And if you add the non-operating assets, what is the value of the non-operating? That is called as the enterprise value. That is the reason just I wanted to.
No problem. But so there is no definition for enterprise value and firm value.
Okay.
This is something that I have come up with, which can be, again, the concept needs clarity. That's the idea behind this.
Yeah, the concept, of course, clear, of course. Whatever the operations are there, that is fine. Of course, people call it as business value, or maybe you are referring it as enterprise value.
Yeah.
When put together, what are the non-operating assets also, if you add value of that to the as a whole, as a firm or enterprise, of course, this depending on the usage.
Okay.
Yeah,
so firm, or if we are interchangeably using firm and enterprise, what you're saying is right. That it can be the business value.
Yeah.
I am interchangeably using business and enterprise.
Correct. Okay. Yeah,
so
sure.
That's where we are. Any other questions?
Thank you.
Fine. So quickly, how do I calculate the risk-free rate? I don't take the pains of going into the risk-free rate from making all these calculations. I directly go to the RBI. RBI gives me the 10-year GSEC rate. I don't take risk-free rate on a yearly basis and calculate cost of capital on a yearly basis separately. It becomes a very tedious process. So what I usually do is I take the 10-year government security rate that is published by RBI on, I think every week they are making a publication. I pick up information from that. That would be my risk-free rate. And with regard to equity risk premium, I go on to take Nifty. Every time I make the calculation, I take from that date 20 years, whatever is the Nifty index that is available. I take that. Publicly available dividend information I pick up. Investing.com has that information. Pick up that information. Public information, this dividend information is available. I pick that information. Okay, I put you on mute. So that information I pick up, and with relation to market risk premium, which I used as proxy for ERP, I do the calculation myself. With relation to beta, as I told you, this information beta need not be Indian beta alone. So I go on to Aswath Damodaran's site. Don't take the levered beta. Don't take the unlevered beta. Look at unlevered beta corrected for cash, because when you go to Aswath Damodaran's site, there are going to be multiple information available. Country specific, sector specific information are available. Look at the overall average beta on a specific for your particular sector as an under the column unlevered beta corrected for cash, whatever value that you have, you pick that up. That would be the starting point. But can I use the unlevered beta corrected for cash directly in my calculations? No, I should pick up that beta. Then I'll have to lever it based on my company. What is the financial leverage that is available? I'll have to figure out. I'll have to lever it and then use it in my calculations. As a personal preference, I don't go with the FCFF model because weighted average cost of capital involves removing tax. Tax in itself, we don't know. Today, what is the tax rate is something that we already know. But 2 years from now, 5 years from now, what is going to happen, we don't know. Therefore, I don't usually go into FCFF mode, remove, make a calculation separately for weighted average cost of capital and then do the valuation. I do FCFE, remove all the items at the free cash flow level itself, and whatever is the remaining value on that, I directly applied cost of capital and I move on. So these are my personal preferences. Any questions that you have from here on? No questions? Okay. So I think that brings us to the end of the session. Any questions that you have, if you are not able to ask in this session, please write to me. As much as possible, I'll try to respond in the weekends, tomorrow and day after tomorrow. Otherwise, if you come across a difficult concept, or because it's only human for us to not understand certain things. I have not understood a lot of things when I'm doing valuation, particularly when the case which I explained you, with relation to options, with relation to fully explicit period kind of models. Model at the end of the day, it's going to be driven by us. Though the information is going to be from the management, how we are going to drive it is it is our prerogative. We don't even share the working papers with the client, so they don't even know what kind of information that they're giving. How are we going to use it? So we just have to make sure that tomorrow you have proper working papers to explain what you have done to a fellow valuer. If you have done some calculations and if you are confident that you have done it right, just make sure that you run it through another valuer, so that tomorrow at least another valuer can would be able to understand, a fellow valuer would be able to understand how your calculations are made. And that is important, not required for another layman to understand your calculation, but another valuer should be able to at least appreciate and accept that you have done something in the right, with the right intent. You have not just made the calculations to arrive at a value, but rather you have applied your mind is something that has to come out in all your working papers. And with regard to all the cases that have come out, so far cases are taken in disciplinary committee only with relation to disclosures. They have not disclosed this, they have not disclosed that. Very simple matters have been taken up for questioning. Nothing has come out how calculations are made, whether they are using FCFF and KE, FCFE and weighted average cost of capital. These kinds of ulta calculations and all, nobody is taking it into account at all, because nobody goes through these valuation reports. But now all these RVOs are picking up the valuation reports, and disciplinary committee is formed. A group of valuers are sitting down and going through all these valuation reports. Peer review would come into play, where the valuers would go through your report and make calculation, find out whether we have made any mistakes in the valuation. So disclosure wise, calculation wise, if we have something, disclose it, make sure that it is run through by another valuer. If you are a firm of valuers, all the more easy for you to do that. Otherwise also, at least run it through a fellow professional, so that you don't make any mistakes and end up in trouble. So anybody from Divya Jyoti Foundation, if you would want to take over, please take over from here.
Sir. Yes, sir. So no questions coming up. Therefore, we end the session here.
Yeah.
I thank our speaker, Santosh ji, sir, for a very nice and informative lecture. Thank you very much, sir. The topic was explained in detail, and you have given enough opportunities to the participant for interaction. Thank you very much. Thank you, participants, for your participation. I would have liked more of questions from you, but the topic is very dry. So
no, there is one important thing here. The value now goes towards IPL. Sometimes they'll have to allocate for IPL. Therefore, it will move in that direction. So I'm happy that I'm giving the value time is being given for the valuers for looking at following up IPL.
Yes, sir. Yes. So thank you, participants. Kindly share your feedback. Thank you very much. Thank you, Kajal. Thank you, sir.
Have a good day.